The European Central Bank this morning raising interest rates by 50 basis points. The hike marks the first time the ECB has raised interest rates in over a decade. It comes ahead of the Federal Reserve meeting next week. The next week, two-day Fed meeting is happening Tuesday and Wednesday, where the market is pricing in a 35% chance that the Fed raises interest rates by a full percentage point. It is likely we will see the Fed raise rates by 75 basis points. Former Reagan economist and the author of Trumponomics, Art Laffer, is here right now. Art, it's great to have you. Thanks very much for weighing in. The ECB this morning raised interest rates by half a point. Your reaction as the ECB says it is responding to inflation, that and ahead of the Fed meeting next week.
Finally, what, the first time they've raised rates in 10 years? I mean, I know Christine Lagarde, and she's a lot better than the previous ones have been, but they should follow interest rates. They shouldn't try to lead interest rates. They shouldn't try to control the world. Controlling people never win. They should let markets set the rates and then have the ECB follow those rates, Maria. That's the only way we can get tight enough money to be able to really bring this inflation under control. Otherwise, this inflation is going to continue, and my fears is that it's going to continue quite substantially very soon. So they need to follow rates. They need to let those rates rise to tighten money just the way Volcker did it, and we can then win. But the ECB at least made a gesture in this direction, and I might tip my hat to them for doing that.
Art, it seems like we're seeing a little bit of a change in sentiment. So the ECB raises rates today. The Federal Reserve raised rates 75 basis points at the last meeting. We're expecting another 75 basis points next week. But look at this market. The month of July has been very good for stocks. The Dow Industrial's off of the lows of the morning. It looks like this market wants to rally again this morning, even though you've got researchers at Citigroup calling for a global recession being a clear and present danger. Citi economists are forecasting a 50% chance of a recession in the next year. Art, your thoughts on what the second half looks like?
Can I just say, how can they forecast a 50% chance of a recession when it's already happened, Maria? The first quarter was negative. This second quarter probably is negative as well, if you believe the Atlanta Fed. The recession is already here. It's already happened. 50% is just a silly number. We're in a recession. The question is, how bad is it going to be? And I think with some of the things happening, with Joe Manchin's blocking the next big Build Back Better, with the Fed finally realizing that interest rates need to go up and go up a lot, with the ECB doing this, I think the risks of a real bad downturn are diminishing quite substantially, and that would lead to a nice market response. I am hopeful that the elections and all of the changes that are coming through will lead to a substantial market response in the positive direction. I'm still very worried, but these pieces of news are good. You're seeing some of the increased unemployment claims. You're going to find that's happening. We are in a recession, and this is going to last for a while. So the less damage it does, the better off we will be, and the better off the markets will be.
Well, we know that this administration and the Democrats' climate agenda has stoked inflation already, and yet Joe Biden yesterday in Massachusetts said he doesn't care what Joe Manchin says. He's not buying what Christian Sinema says. He's still going to push through his climate agenda, and he'll do it through executive order, Art.
You know, there's an old phrase, and it's probably inappropriate to use it, but there's no fixing stupid. These are bad policies. They have been bad policies. They led to awful consequences, and these guys just keep pumping the same bad policies. You know, the old country phrase here in Tennessee and Kentucky is there ain't no lesson from the second kick of a mule. And these guys are just doing it. I just hope we punish them badly in the election and then can change to much more rational, tight money, tax cuts, increases in supply, and bring that inflation down with a good economy.
All right, well, then that means you think the November elections will be a catalyst for the markets. Let me bring Mark Tepper in here, who's also been watching an economy that has been slowing down substantially. Mark?
Yeah, and I'm hoping the November elections are a catalyst as well. I'm just not sure how long that catalyst is going to last. So, Art, I was having a dinner conversation with a buddy on Tuesday, and I told him I feel like the market's kind of been on borrowed time going back to 2009. You know, we've been on this hyper-stimulative QE kick with interest rates and fiscal support on top of that. And now that's all reversing. The purse strings are tightening, spending is reining in. We're reversing course on interest rates and going from decades and decades and decades of interest rates slowly drifting lower to now increasing. And to me, this seems like a seismic shift that maybe investors are underestimating how substantial and how drastic this is. What do you make of this?
I think you're totally right, Mark. I mean, completely. Now, we did have low interest rates there up until the last year, let's say last year and a quarter, because actual market rates were low. And Fed rates should stay low. They should follow the market. When the market went up, the Fed showed its true colors and did not follow the market as it has always done. This is a seismic change. We haven't had anything like this since the late 1970s. Now, I happen to have been around in policy circles back then in the late 70s, early 80s with Reagan. And, you know, all of these discussions came through. All of the debates that we're having now were had then. It was a seismic change. And you can see what happened as a result of Paul Volcker and Ronald Reagan. Sound money, tax cuts, pro-growth, and we had this spectacular boom in the economy. I am hoping the same thing happens, Mark. And I've been talking with my friends, and it is a political groundswell earthquake that's coming along, and I hope it works out very much in our favor. But you're right, it's seismic.
Yeah, and then in terms of the second half of the year and beyond, Art, I mean, a lot of people are now wondering when the Fed stops raising rates and starts cutting rates. I can't believe this conversation has taken place, but this is what's going on Wall Street, Art. How long will this experiment last? And we haven't even mentioned the fact that the Fed has a $9 trillion balance sheet that they have to unwind as well.
We've got lots of problems we can talk about, Maria. The Fed should not be setting interest rates. The Fed should be following interest rates. Markets should set interest rates. Markets should set prices. Markets should set quantities. The Fed should follow it, not lead it. And that's the whole hubris of this perception of power that these people have. They think they can sit there in Washington with their lack of credentials, where they're sitting there chatting with their staffs. They think they can control the economy. They can't. They should get their damn hands off the economy and let the markets solve themselves, which they would do a great job, just the way we did in the early 80s with Volcker and with Reagan. And it really worked, Maria, and it really worked beautifully. You saw this great prosperity coming, and the same lessons should apply today as applied back then. Create an increase in the supply of goods, which will bring down inflation, make money tighter, which will bring down inflation, and both of them together will lead to enormous prosperity. And I'm just waiting for that to happen, and the Fed will discover it sooner or later. I hope it's sooner rather than later.
But that's not what's happening in the administration, Art. You know that they want to push through more spending and higher taxes. That's what the reconciliation plan being talked about is all about.
But they've lost. You know, Manchin and Sinema have stopped them. I mean, we could have had a real catastrophe with Build Back Better, which was much more like $6 trillion rather than $1.5 trillion, as you know. I mean, we could have had, if it hadn't have been for Manchin and Sinema, this country would be in disastrous shape today. And Manchin appears to be holding the line on this next round as well. And if he's looking to inflation as his guide as to whether he's going to hold the line, the CPI is going to be rising in inflation for the next 3 months substantially. Those numbers that are being dropped from the index, the 3 months that are being dropped over the next 3 months, are very low numbers. So you would have extremely low new numbers to be able to get the inflation rate to actually fall. That's not going to happen. This inflation rate's going up over 10%. And it's going to keep on rising until we do the right policies. It's not a matter of luck or guess or flipping a coin or looking for a four-leaf clover. This is economics, and economics follows very strict principles and rules. And these guys will have to learn to follow them if they want to bring that inflation rate down and keep this economy strong. But so far, the politics has been very much better than I thought it would be with Biden, this Senate, and this House.
Yeah. Art, it's great to have you this morning. Thanks very much.
You've got to be with me on that, aren't you, Maria?
Yeah, no, I understand all of this stimulus that has been thrown at this economy, and that's why we have on Thomas Hoenig so much. Thomas Hoenig was the president of the Kansas City Federal Reserve, and he was the one dissenter back in 2010. He dissented as the Fed was coming up with all of these easy money policies, worsened by this administration and all of the free money, which is, we knew from day one, too many dollars chasing too few goods. That is what is inflation.
Exactly.
Thank you, Art. Great to see you, and we'll keep following all of that.
Thank you very much, Maria.
This morning.
Thank you, Mark.
All right, you too.